So welcome and thank you for coming. It's so good to see so many of you, like Dan said, and well, what a week or a week and a day it has been. I don't think we've sort of stopped in the run-up to the budget, and we certainly haven't stopped since. So I'm going to talk to you today, or tonight, about the power of pension contributions. I've got about 15 minutes. I'm going to try and keep the pace up, but the slides will come to you afterwards, and I will be around after the session if you've got any questions, so please feel free to come say hi and ask me about pensions, ISAs, and all of that good stuff. So, what am I going to cover in my 15 minutes? I'm going to do a very quick recap on how much you can pay into a pension. And then I'm going to spend some time looking at something called adjusted net income. So that's kind of the thread that's going to go through my talk tonight. And I'm going to run through some case studies about pension contributions. So looking at when you pay money into a pension, you can, of course, get tax relief, but what else can you sometimes win back? So how much can I pay into a pension? Should be a really simple question to answer, but in reality, a little trickier to work out sometimes. So there's two main levers that the government can use to control how much you can pay into a pension and how much benefit you can get from that in the form of tax relief. So first up, we've got the annual allowance. Now that's £60,000 a year for most people. And it covers what we call the gross value of all contributions made by you and on your behalf across all of your pensions for a tax year. Now, it can be lower if you've got income plus employer pension contributions of over £260,000 a year, or if you've already accessed your pension and taken a flexible income. So in those cases, it might be lower than that £60,000. Next up, tax relief. So I'm talking here about personal contributions for UK residents. You can pay in up to 100% of your what's known as your relevant UK earnings gross over a tax year and get tax relief. Now, that is earned income, so things like dividends and interest don't count towards that tax relief limit. That is purely focused on relevant UK earnings. If you don't have any earnings, you can still pay in up to £3,600 gross a tax year, so that's our 2,880 number. Now, that might be useful if you've already maxed out your own allowances and you want to still pay into a pension and make a contribution that gets a bit of tax relief for perhaps a non-earning spouse or a child or even a grandchild as well. Now, with pensions like SIPs, when you pay an amount personally into that pension, it gets bumped up, grossed up if you like, by 20% basic tax relief. But if you pay tax at a higher rate or an additional rate, you can, of course, claim extra tax relief. You can do that by contacting HMRC directly. If you do a self-assessment tax return, then you'll probably do it by that, but there are other ways you can contact them. Now, I appreciate that's a very, very quick run through. They've gone into a little bit more depth on an article on our website. It's called Contributing to Your Pension. When you get the slides, the link is there. If you go to the AJ Bell website, just search contributing, you should be able to find it as well. It talks a bit more about the different situations and when you might not fit into kind of the norm there. Now, I also should say this week, obviously, we were very pleased that those tax relief rules and the allowance weren't tinkered with. When I wrote this talk for our Manchester Roadshow, which was just before the budget, I was slightly nervous, but you know, in some of the doom and gloom, there was some good news when it came to pensions. Now, onto the kind of the techie part, adjusted net income. It's a bit of a jargon term. I don't like to use jargon as a rule, but it's an HMRC defined term and it's important for my talk, so I'm hoping you kind of forgive me on this occasion. And as I say, it kind of weaves through my talk. So what actually is it? So it's your total taxable income. So not just your earnings here. Obviously, I talked about earnings for tax relief before. Now we're talking about total taxable income, and that's all added together before any allowances are taken off. So not just earnings. But with adjusted net income, you can deduct certain things to get to that final figure. So the first of these is trading losses if you are a sole trader. The second is charity donations that qualify for gift aid. So you can take off what we call the gross value of that donation, so the donation plus the top-up that the charity gets from the taxman. And finally, what we're here to talk about tonight, you can take off pension contributions that you make, the gross value of those contributions. Now, why am I talking about this funny thing called adjusted net income? What's that got to do with pensions? Well, it covers the test for a number of different things. I was having a slight clicker anxiety there. So if we work our way up the pyramid there, it's the test or the allowance to see if you can claim certain things like the personal savings allowance. I'll come on to what that is in a second. Whether or not you can claim child benefit, if that's applicable to you. Whether or not you can get your full tax-free personal allowance on your income. And also whether you're entitled to certain childcare support for younger children. And at the top of that pyramid there, I've talked about the tapered annual allowance. It's the kind of the basis point for that calculation to see if you're one of those people who might have your annual allowance for pensions tapered down. Now, I'm going to cover the first four, working up from the base of the pyramid there. Tapered annual allowance would take me more than 15 minutes of the whole talk, and I'd probably send a lot of you to sleep, so we'll save that for another day. Now, onto the personal savings allowance first. What is it? So it's an allowance that protects interest that you receive that's not kind of protected in a cash ISA, for instance, from tax. And it's set at £1,000 for basic rate taxpayers, £500 for high rate taxpayers, and then if you pay tax at additional rates, you don't get any allowance at all. Now, it's been around since 2016, but kind of in those early years, people weren't perhaps quite so bothered about it. When you think about the interest rate environment we were in, perhaps people weren't really earning that much interest to worry about it on their cash. Certainly kind of versus sort of cash ISAs and what you could protect. So why do we care about it with pension contributions? Well, as we've talked about, a pension contribution can lower your taxable income. It can lower your adjusted net income. And if you're particularly close to that higher rate tax threshold, so you're £50,270 a year, you could potentially pay some money into your pension, get a nice boost from tax relief as well, get a bit more in your pension, but perhaps unlock an extra £500 worth of interest for the year. And why is that important? Well, we are forecast, 2.1 million people are forecast to pay tax on interest on their savings this year. And, for people who are a bit more familiar with the rules, perhaps that's not a big surprise, perhaps that can be planned for, but there's going to be an awful lot of people who are perhaps going to get, an unexpected tax bill. We've been used to that kind of lower interest rate environment, and people might get a slight shock when they realise they're getting tax deducted because of what they've saved. So next on to child benefit, kind of the next run of the ladder, if you like. So you can claim up to £25.60 per week for the eldest child and £16.95 per week for every next child if they're up to 16 or if they're still in higher education, usually up to around 20 years old. Now, there have been some changes to the rules recently, but it's still affected by our adjusted net income, and we can still maybe do some work to claim it back if you find that it starts to get taken away from you in tax charges. So currently, child benefit can be clawed back if your adjusted net income is above £60,000, and it's clawed back via a tax charge called the High Income Child Benefit Charge. Now, if we've got a household and either you or your partner receive child benefit and someone in the household has income, adjusted net income of over £60,000, the child benefit starts to get clawed back. So for every £200 you are above that £60,000 adjusted net income, you lose 1% of the child benefit in this tax charge. I prefer to kind of work in case studies. I find it easier to illustrate what I'm trying to talk about. So if we think about Family Jones here, so one parent earns £70,000. They've got two children. So at the moment, they can claim £2,213 in child benefit a year. If we look at their income tax position, £15,432 in income tax and a high income child benefit tax charge of half of the value of that child benefit. So here, total tax is just over £16,500. Eagle-eyed amongst you will notice that I have removed NI or national insurance for the purposes of this slide. I'm worked in this industry long enough to remember when national insurance wasn't really a tax and governments would tinker with it and be able to say that they weren't putting taxes up. But I think after the last few weeks and all the discussions around working people, we are all in tune with the fact that it's very much a tax. So where do pensions come in? So if we go back to Family Jones, if that parent actually paid money into their pension, they can lower their adjusted income. So for instance, if they paid in £8,000 to a pension, like a SIP, that lowers their adjusted income by £10,000, and that's because the £8,000 gets £2,000 basic rate tax relief. So their adjusted net income handily goes down to the start of that threshold of £60,000, and it lowers their income tax bill too. So not only do they have no high income child benefit charge, they pay just over £5,000 less in tax, and they've got £10,000 in their pension. So it works out, this tax relief, if you like, in this instance, is just above 50%. Right, so for our next two cliff edges. So part one, I've done a lot of writing about the £100,000 cliff edge lately. So it kind of feels natural to talk about it today. So personal allowance, I mentioned it at the start of my talk. So most people get their first slice of income tax-free. The personal allowance is currently set at £12,570. But where adjusted net income comes in is if your adjusted net income tips over £100,000, you start to lose this personal allowance. You lose your tax-free allowance. £1 is lost for every £2 your adjusted net income is above the £100,000 threshold. And it's lost completely at the rate additional tax kicks in. So £125,000, 140. Nice round numbers there. And what does that mean? So if somebody earns, let's say, £126,000, or they have adjusted net income of that level, they effectively pay 60% tax on that band between £100,000 and just over £125,000. So, the tax situation in the UK is complex enough. That's before we even get to kind of Scottish rates of income tax that we're not talking about today. So how does that affect somebody? So if we think of someone who's got income of £100,000, they get a little bonus of £2,000. What does that do? It means they pay £800 high rate tax straight away on that £2,000, they're 40%. But they also lose some of their personal allowance. They lose £1,000 worth of it, and that £1,000 is then also subject to 40% tax. Oh, I'm being trigger happy there. So that £2,000 bonus ends up meaning £1,200 in tax, and that's where we get our 60% tax rate from. Well, the situation gets even worse for parents of young children. And that's because the £100,000 adjusted net income works as a cliff edge for various bits of childcare support that are out there. So the first of those is tax-free childcare. And this can be claimed, and it's worth up to £2,000 per child per year. And as soon as you tip over that adjusted net income, it's not a taper down like the personal allowance, it's just gone. And the same for the free hours. So the free hours childcare scheme was expanded last year. It will be expanded again next year. So at the moment, if you are over that cliff edge, you will lose 15 extra hours a week in term time for 3 and 4-year-olds. You will lose all of your 15 hours current entitlement for children aged 9 months up to 3. And then when the new changes come in September, it actually goes up to 30 hours, so that it would all be lost then as well. So what does that mean for those young parents? We've already seen a 60% tax rate. It all gets a bit wild now. So if we assume the same family, but they've got 2 children, age 1 and 3, and the breadwinner earns £100,000, they use tax-free childcare, that breadwinner then gets that £2,000 bonus. What does it mean? So the £1,200 tax that we talked about before, plus £4,000 worth of tax-free childcare, completely wiped out. And then another £6,730 of childcare hours. So we've used the Coram Childcare Report to kind of value those free hours, because it's not quite as simple as 15 hours the way it works out for parents who've got children at nurseries and in childcare. But £6,730 worth. So that £2,000 ends up costing them money. So in lost childcare support, extra tax, it's nearly £12,000. It's a vile effective tax rate if you like working in those. It's really a huge cliff edge. So that same person, that bonus costs them money. So what can pension contributions do? Always back to pensions here. So instead of taking that £2,000, if they can divert that into a pension, they've lowered their adjusted net income. So that can work in a workplace scheme where you can just divert it straight away before kind of taking it, paying the tax and paying it back in. But if that's not possible, you can also pay £1,600 into something like a SIP, get the tax relief, and you'll end up in the same position. So they pay that into their pension. They get £2,000 extra in their pension. There's no extra tax because they've got the tax relief. There's no loss of personal allowance, and they keep the childcare support. So that pension contribution, £2,000, if we say, if it just comes straight out, sacrifice, for instance, wins back 60% tax relief, plus that over £10,000 in childcare support. A pretty powerful pension contribution for people in that area. So I can see the clock flashing, 1 minute left for me. So just leaves me really is to kind of run through here what we've covered today. So we've talked about what adjusted net income is and what things are impacted it, what calculations is it used in, what kind of allowances does it determine, and how can pension contributions kind of help you win some of those lost allowances back. So the 4 key things we've talked about today: personal savings allowance, if your income is in that kind of £50,000 area, £60,000 area, and you're going to lose some of that tax-free interest. The high income child benefit charge when you start tipping over £60,000, and then the loss of personal allowance and childcare support as you tip over £100,000. Now, it also works, a quick shout out to capital gains tax as well, because you've got 2 rates of capital gains tax depending on whether you're a basic rate or a high rate taxpayer. The same principle applies, so a pension contribution can lower your taxable income, and it could potentially bring you into that lower rate of capital gains tax. Now, of course, that rate has gone up, but there are still those 2 distinct rates. So a similar theory works there. So that all just leaves me to say, as I'm flashing, saying I've run out of time, thank you very much for listening. It's always nice to talk about pensions. I know maybe you're here for the investment chat, but like I say, if you'd like to come and grab me afterwards and ask me any questions, I'd be pleased to help. Thank you very much.